if you guys don't know Dennis Loxton, Dennis is probably one of the most highly known and respected reverse mortgage professionals in the country. He's been in the reverse mortgage industry for a very, very long time, and he's going to kind of, you know, educate and hopefully teach you guys a lot about the reverse mortgage space. As everyone knows, production's down, and reverse mortgages don't necessarily function in the same way or in the same market, and are not as sensitive as some of the other products that are currently offered in the mortgage space to interest rates. And so Dennis is an expert, and he's going to give you kind of the rundown and hopefully figure out a way to increase your business in 2014 in the reverse mortgage space. So Dennis, it's all yours, buddy.
Well, Brian, thank you very much. If you have any issues, if there's any questions you'd like to share during the call, please use the chat function. If we don't answer your question, please drop a quick email to me. You'll have an email address up here shortly. I do have another monitor up so we can try to answer those as we go so we don't overlook anybody's questions. Brian, thanks for the introduction. If I had known I was getting an introduction like that, I would have gone sober a long time ago. We all had to give up something for Lent, and my kids talked me into giving up vodka. So the last 2 weeks should be interesting. So thank you, everybody, for joining us. My apologies for the technical difficulties. You can blame it on me since I'm still running Windows XP. So I guess I'm one of the millions that haven't made the switch. I'm going to go ahead and jump into things. And let me go ahead and minimize my view briefly. There we go. Perfect. First of all, for those of you that don't know Brian, I've had the privilege of working with Brian at several different firms over the years. He's going to talk a little bit more about his firm towards the end, but obviously one of the preeminent valuation firms in the industry. I've been very fortunate, very blessed to have worked with him a number of times in the past, and just superlative, start to finish, just outstanding service. And again, but I'll let Brian tell you his story because he can do a lot more compelling job of it than I can. We're going to stay on a fairly tight, probably 40-minute or so frame today, and we want to make sure that we answer all of your questions, so please feel free to chime in along the way. Please feel free just to send us a note if you have any questions. You have my email. It's for those of you joining us on audio. Please write down my email, Dennis, D-E-N-N-I-S, as in Sam, at Loxton, Loxton.us. And that's Dennis at Loxton.us. If you have questions or would like a copy of the slide deck, and we'll be happy to distribute those at the end, and also to those that have registered. The agenda today. First of all, why even look at the reverse mortgage business, given some of the things that have been said in the past and that we've seen happen? What's going on in the world? Product changes and updates. HECM 101 and responsibilities of those coming into the space. For those on the call that are existing originators or know HECM or currently in the space, bear with us because some of this will be a little basic, but we still think it'll definitely be worth your time. Operations, very important, along with compliance, marketing, selling. Obviously, show me the money. Everybody wants to know what the revenue opportunities are like. But I think more importantly, talking about transforming your current firm into leveraging your existing book if you are in the TPO or non-delegated world on the forward side, and also talking about tremendous opportunities in educating real estate professionals and also your servicing portfolio. By the way, I should warn you, I am one of those annoying guys that used to sit in the fraternity house and do nothing and just watch movies like Caddyshack 24/7. I have a degree from Purdue. I'm not really sure how much I actually attended, but so thank you in advance for indulging us for some of the old movie and TV show references. But Saul Goodman, I think, really is a good analogy for this, because I'll tell you a brief story. Towards the end of the last boom, when I was running a division in Florida, we had a lot of people call us that had just gotten into the mortgage industry. As we know, obviously, the standards nowadays are much more strict than what they used to be back then. And we had to educate them that this is not a get-rich-quick business, that this really is a transformational change that you're going to make in your practice. And for those folks that thought that this is something that could hop in 30, 60, 90 days, be doing business quickly, well, we had to warn them that they had to prepare for something else. So, by the way, for those of you that weren't aware, this is the one snowplow in the state of Georgia. So we like to have some fun with this. We'll make a lot of kind of off references, but this is one of the themes that we really do hope that you'll see today, is that if you're willing to kind of change the mindset of how things have worked in the past and really rejigger or kind of shift your entire firm's paradigm, that you can do very, very well in this space, but it is a very long time to success. And you'll question yourself more than a few times. But like we said, this is a very rewarding business if you have a passion to serve. These are not, as you already know, these are not 30-minute appointments. It's not unusual to spend 2 and 3 hours in an appointment with folks, just talking about life in general. So this is why we say that the usual short-term time frame just doesn't work here, that a patient mindset, if you do niche products currently, if you're doing home path, maybe if you do some certain manufacturer types, but definitely if you're in renovation lending, you already know what it's like. So that definitely, I think those skill sets, particularly, from those originators, will translate very, very well into success here. Well, as we all know, I mean, Brian said it, as we all know, we're in the middle of a structural shift in the market. You know, we've seen arguably the biggest refi boom in history just leave us. And, you know, let's face it, you know, we are in what is a difficult adjustment to what the new world is going to be like. However, the benefit, by definition, those of you that are on the call, you've already ridden out one of the worst markets that we'll ever see. So by definition, you've got the staying power to make it, and we look forward to sharing further ideas with you on that. I don't like to dwell on the doom and gloom, but it presents a tremendous opportunity for us. You know, we've lived through a major bear market in 2001. We lived through another one in 2008. And arguably, depending on who you believe, one is either right around the corner or coming within the next few years. Not that that's negative. Those are just normal shifts in the stock market. At record low rates on savings, you put all these factors together, they really have conspired, if you will, to work against the largest demographic group in our country, which again presents a tremendous opportunity for those of you that have the skill set and want to work with folks in this demographic group. The other major thing that we're seeing, and it's not only the economic pressure on these folks, but it's also a desire to get out of the house that some of them have been trapped in since 2006. And I say trapped, obviously, not from a negative sense, but if you've been trapped in your home since 2006, and in a lot of areas you finally have the wherewithal to get out. Equity's back in a number of areas, and folks that feel like they've been freed, if they will, to finally move into their last home or their next to last home, well, they want to do it, and we see a lot of folks doing it. So that's, we're going to talk about more at the end. There's a historical perspective that we'll kind of come back and look at. I'll talk about it more later, but in some markets, you know, it is easy to look at and say, oh my gosh, in November my production's off. It's awful. It's going to be this way forever. You know, it's terrible. Might as well go sell Mercedes. However, what I would caution you, flip around and look at the bright side. The bright side is, as we come out of this cycle, you're coming into a market. I can tell you in places like Florida, we have 50 and 60% less originators in some markets than we did 7 years ago. And in some smaller areas, it's closer to 75 to 80. So, those that are on the call, you're relaunching your practices at a time when you have very, very little competition. So this presents a tremendous amount of opportunity. You're going to hear me use that word quite a bit for the other 98% that this industry currently isn't marketing to. And the major benefit you have at your back, as opposed to your face, the headwind, is that the press coverage is increasingly positive, as was evidenced by a recent Reuters piece at Reverse Mortgage Daily today. So again, if you have any questions, go ahead and drop in a note in the chat box or send me an email, because we are checking those if you have any as we go. Product changes. I was told when I first got in the business that I was never to use the term LTV. For those of you who don't know me, I'm actually a recovering financial advisor. I am a certified financial planner by trade. I do maintain my designation. I do keep it current. But I have been in the financial services business really since 2004. I did spend 10 years in both retail and wholesale production, mostly wholesaling to broker-dealers and banks, primarily variable annuities and mutual funds, before I got into the reverse mortgage business in 2004, 2005. So it's a tremendous opportunity, but I was told never to use the term LTV. So we spent the first 4 or 5 years trying to tell people it's not really an LTV, it's a principal limit factor. And finally, in talking to mortgage bankers, I've just given up. So when we say PLF or LTV, we do mean the same thing for purposes of this discussion. There was about a 13 to a 15% principal limit factor or LTV cut, depending on your perspective, late last year. For this particular example, it was an older example that we ran, which is why the interest rate was a little higher. It did make a meaningful difference. And has that had a short-term impact on unit volume? Well, it certainly has, as anything would. However, what we're seeing is that, yes, clients now are qualifying for less than what they could a few months ago. However, what we are now seeing is that we are seeing a significant amount of folks come out of the woodwork. So we'll talk more about margins, and we'll talk a little bit more about revenue later. But we really also have to remember the fact that we have traditionally low interest rates, and we have home values starting to come back. So it's been positive in terms of the net-net. Just people ask me, what do people normally draw on these? If I'm trying to build a pro forma, how do I build one? On average, we budget, and again, these are all just when we're making models and try to determine compensation and expenses and marketing. We expect funded amounts, and I'll use the term appraised value here, that'll range from anywhere from 20 to 40% at closing. So that means on a $200,000 home, on average, if you take all your loans and throw them in a blender, they're going to fund anywhere between $40,000 to $80,000 at closing. And again, that's not an absolute number. Some may be higher, some may be less, but that's a good, reasonable range to work from. One of the things that has been an adjustment for some folks to be able to grasp in our business is that as funded amounts at closing drop, because those of you may have heard about high premiums on fixed rate loans that were done a year and 18 months ago, and everybody doing full draw loans, those are gone. So we are back to what we had back in 2004, in my opinion, which is one that's still line of credit based. We do have a fixed rate available for certain clients, but you have to be very careful with marketing expenses and overhead. That really is critical in this world, because if you don't have your marketing expenses and overhead in line, wow, you're gonna be in a world of hurt. So, okay, thanks. Other product changes. There happens, and I'm not going to spend a lot of time on the product changes. If you're really interested, drop us an email, but this is really just intended to be a 10,000-foot view. Limits on draws at closing, generally limited to liens, mandatory obligations, and a slight buffer. Very quickly, obligations are generally defined as liens, closing costs normally included, insurance required, or repair escrows, or any other property taxes, HOA liens, things like that. So to keep it very simple, again, at a 10,000-foot view, if your liens are below 60%, that's generally what you can take, plus your small buffer. If your liens are above 60%, that's what you can take, plus your small buffer. And generally what we see, just from almost like a sniff test, if you will, is that clients are generally funding, and again, this is still very early, so it's a rough average, and it's just our particular firm, but they're funding on average anywhere, they're either funding 40% at closing, or they're funding close to everything at closing. That can be an anomaly because, again, we only have a few months of history to work from, but that just seems to be what our experience is right now. We're seeing very few full draws at closing, with the exception of purchases, and we're also seeing very few no draws at closing. So for whatever it is, that may change, obviously, as spring comes and the market heats up again, but that's just passing that on. The big thing is if you're drawing less than 60%, if your liens are less than 60%, you're effectively cut off up to that 60% limit up until the end of month 12. So at the beginning of year 2, you can draw your other 40 out. And the thought process that HUD had there was by limiting the cash out refi, if you will, just to use an example, by kind of putting some brakes on the cash out refi, they extend out the time period before the loan crosses over and decreases pressure on the MMI fund, and which is why you've seen the MMI fund, or the projections, turn positive since these changes have been made, as opposed to the numbers that were talked about in the broader press. However, there's been some positive things happen. There has been a reduction in upfront MIP. So for the clients that don't need it all, or the clients can afford to draw less than 60% of the available principal limit at closing, the upfront MIP is only half a point. That's huge. I can tell you, because this is the carrot of the carrot and the stick. So the positive part here is that by allowing them to draw less than 60% at closing, by incenting them to, on a $200,000 home, that's a $4,000 discount on MIP. That's significant, and this is why you're starting to see on the early tests that we've kind of conducted with financial advisors and other folks in our areas, they like that. They like that very much, because it takes away one of the major objections to a HECM, which is it costs too much money. And I know there are ways to address that, but that is a nice way to address it with advisors. And there was also an article today talking about a pilot program in Minnesota with using reverse mortgages in conjunction with long-term care and aging in place. We really do expect you're going to start to see more use of reverses being blessed, if you will, by state governments, at least on pilot projects, to look at funding more aging in place needs, because it just, as anybody who's worked with state budgets know, that just they're going to continue to be pressured. So these are all very positive developments for the program. Now the flip side is, if you are using more than 60%, you got it. Yeah, you did get a fee increase. So on a $200,000 home, the upfront MIP that you would have paid that was $4,000 is now $5,000. The 1 1/4 ongoing is unchanged. That, believe it or not, has not been, the increase from 4 to 5 hasn't been the deal killer that we thought it would be. Yeah, there are a couple of clients that weren't thrilled with it, but as you see it used in some purchase scenarios going forward, you'll see. You'll see why it hasn't been as big a deal. I'm not going to spend too much time on this slide, but we do also have, and this will be part of the deck that comes through to you, but we do also have, as an industry, a product that we're very, very excited about, that we think is a nice midpoint between the old full draw fixed rate HECM of the past that was criticized, even though studies show, as anybody who's worked with this demographic group know, studies show that they do prefer a fixed rate by significant percentages over adjustable rates. It's a nice midpoint between the adjustable and the full draw fixed rate. And that is, there are now several investors that offer hybrid loans where you have both a fixed rate on your initial draw and also a guaranteed fixed rate on the line of credit moving forward. And I don't want to spend too much time on particular products from different firms, but this is a significant development, particularly with the financial planning community. Because as we know, clients in that demographic and trusted advisors, they hate both adjustable rate loans, it seems like, and also, taking the full draw when they don't have to. So this has been a nice midpoint. Well, I don't know. I have never had anybody ask us to use a reverse mortgage for investing in pork bellies or orange juice futures, thankfully. And obviously, most of our needs that we deal with, if you will, are generally driven by paying off mortgages. Reverse for purchase is a number two. And then finally, healthcare needs right now are kind of running a close third. So they all kind of run in that general group. But there do come, and I don't want to belabor the point, but I just think it's worth reminding that it does take, generally speaking, at least 9 to 12 months to really get any traction in this line of business. If some people can do it quicker, that's great and that's wonderful. If you have the capital to do it quicker, that's wonderful. But it really does take time to get going. We've seen firms that in some cases have spent 12 to 18 months before they really found their niche and what they liked doing, because the sales cycle is significantly longer than any other product. However, I think what you're going to see is that we are seeing folks that have done nothing but forwards for 15, 20, 25 years, but have been your old school referral-based type of originator, and that can do things like HomePath and 203K that, can pivot. We are seeing some of those folks successfully make the shift into adding HECM to their menu because the mindset is there. One of the things that I would strongly encourage you doing if you're a broker, really leverage 1 or 2 solid investor relationships, really get in deep with them, try to dedicate your business to 1 or 2 of those wholesalers, because you'll have the ability to help leverage some of their compliance expertise. If you're a mortgage banker or possibly looking at becoming an issuer, obviously you already invest in compliance, and you probably know some of the same folks that we're referring to, but if you need a good referral for compliance folks that handle this, please let us know. We'd be happy to forward some folks over to you, because really specific reverse compliance is a different skill set in this space. What we're seeing is that recruiting now is different as well. There are the recruits and the existing professionals that really wanted to stay in the space. Well, obviously we've seen a lot leave as well. The good thing is that we are seeing those long-term professionals, if you will, kind of start to come out of the woodwork and say, okay, the market now is more to my liking. It's referral-based. It's feet on the street, and that's something that resonates well to me. So those types of recruits can be retrained into the space and retrained fairly quickly if that's the mindset that they have. So again, I think everything, if your culture really is one that's centered around, from sales to operations to management to everyone, that's just centered around making your client experience as seamless and as easy as possible, that does resonate well with your trusted referral partners. So while we're on operations, again, if you have any questions, please feel free to chime in or send them over. How do I find specific, and I get this question a lot, how do I find specific staff that can do HECM? And it's hard, because I think, like with any industry, once you find staff that are good and experienced, they're keepers. And people obviously don't want to share them. However, there are a few things that I think that you can do. And first off, experienced staff can be retrained to do HECM. The processors that have done government loans that are good, like I said, if they've done troubled loans, if you will, if there's a difficult file, you send it to them. Those types of folks usually process HECMs well, because let's face it, once you get used to doing the product, it's not that difficult. However, if you're a mortgage banker that has the ability, already has a DE approval for forward, and you really think that this is going to be a line of business, I would strongly encourage you to consider getting your test cases done. You'll need to reach out to your local home ownership center, and they have a process by which they get you set up with your binders, and you're probably familiar with that. The one thing I will caution you, if you're going to send them test cases, make them pristine. I won't bore you with the entire story, but it took us 4 months to get one test case approved because we had 2 errors in the docs with regards to an expected rate on an arm. And by the way, the client's calculations were correct. These were buried somewhere in the closing package. So it's, again, I would just caution you, make them as easy as possible. If you have any questions, I'd be happy to take it offline. The one thing I will tell you, if I had a dime for every time I was told that you can originate HECMs out of Encompass or Point, I'd be a very wealthy man. They don't handle HECM origination. If you're not currently in the space, in order to do your federal data reporting and any other required reporting, most folks will usually input the loan into a reverse vision or an IBIS, or if you're still getting your feet wet, your investor system, and then also do the dual entry into Encompass or Point for your reporting purposes, HMDA and everything else. It seems like it's irritating and it's burdensome, but it really isn't. It's not a major issue. But again, just making you aware of that. Well, I may have made it along the way. I don't mean to make this more difficult than it is. And I probably have, really made it sound like this is rocket science, but it's not. If you've been doing government loans, this is not a huge issue. This isn't a big deal. The one thing I would really strongly encourage you, though, is whoever your vendors are, make sure that they've worked with reverse in the past, that internally they get it, because you are dealing with a different group of borrowers from an appraisal perspective. They tend sometimes to have a few more repair issues, which isn't bad because we're not talking major. Sometimes it's just some deferred maintenance. But a lot of it is making sure that the vendors that you're working with have staff that really understand that you're not dealing with a 24-year-old first-time buyer. You're dealing with somebody who has a very firm opinion about their home, as they should. They've lived there for 40 years. They've put a lot of time and a lot of money into it. And just to understand that there's a little more care, patience, and more of an emphasis on service. There might happen to be a really good one you could find at coasterappraisals.com. And I'm sure Brian's going to talk a little bit more, which, by the way, we've been very fortunate to have worked with them numerous times in the past and absolutely love their service. Areas of concern unique to HECM. Trusts. You'll see a lot more trust than you see in the forward world. Powers of attorney. As there should be, tremendous amounts of scrutiny paid to POAs. This is an area that is highly, highly, highly regulated, because if we see any sort of attempted fraud in this demographic, it is probably, number one, it would be driven by the kids, unfortunately, but a close second would be POAs. Fortunately, with the guidelines that this industry has in place, we don't see it very often, knock on wood. You'll see guardianships. Reverse for purchase is a little bit different, and reverse purchase with an existing HECM being paid off, but don't want to spend too much time on that. We do, if these have already been announced, please forgive me, but we do have new financial assessment guidelines expected for implementation by HUD, coming May, June. As of this morning, we haven't seen them announced yet, but if they are soon, we'll certainly send that as an update to everybody on the call. LO comp is a major, major, major compliance area. We're not compliance attorneys, nor do we pretend to be, except if you want to pick up my bar tab. But expect to definitely see an emphasis on LO comp. And where the industry kind of tends to be coalescing, and again, I'm not practicing as an attorney, I'm just sharing what we see as an industry. The industry seems to be coalescing around to paying LOs the same, regardless of product and regardless of what's drawn at closing. So if you have questions about that, you've got my email. I'll be happy to share with you, what we see firms doing that from a best practices and seems to meet all the relevant regulations from the CFPB. So Again, if you have questions, please feel free to drop a note in or send me an email. One of the things that I would definitely look at as you evaluate getting into the space, there aren't tons of wholesale partners. There are about the same number of folks that are buying either hybrid, what's known as mini core or non-delegated, and also buying closed loans. I think you're going to have to divine, if you will, from talking to them if they really have a handle on the changes that are coming, and as you start to work with them, whatever overlays they have, if they make sense from a business perspective. For example, if a lender tells you, well, we have an overlay of X on manufactured homes, and I'm just being arbitrary. And for example, we believe that if you have a gross adjustment of more than 25% on a manufactured home, that, sorry, we're not going to do it, period. Don't even ask us for an exception. By the way, we prefer manufactured homes newer than the 90s. Again, I'm being arbitrary. Your investors that you're working with should be able to give you a pretty quick explanation of why they like that overlay. And, well, okay, that's part of our business. We all have overlays in some form or fashion. But really, and this is more now geared towards the mortgage bankers in the group that decide they're going to start originating this, underwriting this stuff, just really make sure that you're leaning on, if you will, during your test cases, whoever's buying these, that they're helping you shadow underwrite, because as we all know, NORs are an ugly thing when there's no scratch and dent market. Marketing. Traditional lead buying is really expensive. I'm not being critical. There are firms that do it and do extremely well because they're well capitalized and they can do it, and that's awesome. Most of us on the call, unfortunately, we don't have that type of capital. We're referral based, we're feet on the street, and that's, again, it's not being critical, that's just a different model. If you're a small firm and you're going to go into the business of lead buying, just be careful and make sure you know what you're doing. Because I can tell you at one firm I worked at, we were looking at a cost per closed loan in 2008 of about $1,200 per unit. We thought that was expensive back then, but, we did it, we were able to make it work. We looked at one lead source recently, and we were looking at an estimated cost per closed loan of almost $3,000 per file. And in today's world, where you don't know what you're funding, and with some of the new guidelines that are coming in, you've got to really be well capitalized and know what you're doing if you're going to make lead buying work. So I'm not being critical of it. It's just that really is for the experts who know what they're doing. However, the flip side of that, for the, if you're a firm that's traditionally referral based, you have a lot fewer competitors out there today than you did 6 or 7 years ago. So if you're used to talking to builders, talking to developers, talking to realtors, talking to financial advisors, well, guess what? You've got a lot more folks to talk to than you did back then. So this is what seems negative actually turns out to be a huge positive. Well, I warned you I was a Breaking Bad fan. And I figured somebody would give me some grief for this, but what the heck. If you remember, when Walt finally tries to take all his cash out in the plastic barrels, I think it was the third episode from the end, he finally got to realize it, if you will, and of course ends up losing it, as we all know. But it's funny, because the reason why I like this slide is that ever since I even looked at the space in '02, everybody kept talking about the potential, and this really is meant to be tongue-in-cheek, so please don't take it literally. But, we're looking at this and we're saying, okay, here's an industry where if we dedicate the time and the effort to being practitioners of the space and do it right, we've really found something that we can serve people, do the right thing, provide a tremendous social good, if you will, but also, do well in the meantime. And it seemed like we were getting there in '05, '06, '07. Obviously, we know the correction that came, was a tremendous adjustment for everyone. We're starting to see, however, that the opportunity that we thought that was there in '04 is finally here in 10 years later. So the industry conditions are very similar to what they were in 2004 before the product took off. Consumer awareness is better. The changes to the product make it a legitimate avenue for funding other products, and we're not talking about orange juice futures or 20-year surrender charge annuities. We're talking about funding long-term care needs, healthcare needs, et cetera. Um, I may be wrong, but in the short run, at least the gossip on the grapevine is that no mega firms really are planning to enter the space. It seems that the mega firms, as of right now, that could change tomorrow, of course, but they seem to be preoccupied with some legacy issues. Folks that do business in their local markets as a referral base can do very, very well. We're seeing, the good thing is those are on the call haven't experienced the corrections and the changes that those of us have that have been through the business the last 10 years. You would be amazed the incremental difference that can occur in your revenue just from adding 1, 2, 3, 4, 5 more loans a month. Because in reverse world, if you manage your overhead well, it is an exponential increase to the bottom line if you manage your overhead well. The market opportunities in the new growth areas, this industry has marketed to the 2%, not being critical, it's just where we've been, but this industry has marketed to the 2% for years. Well, the 98% that we haven't marketed to is now emerging, and this is going to really be where the growth of this industry occurs, as we all know. If we have any banks or credit unions on the line, or servicers, you've got a built-in advantage due to the fact that the cost of your lead generation is almost zero. So, again, that's an advantage you have over the rest of us. I really would also caution that training is critical here, and really as we all know, a good wholesale or correspondent AE is critical. And whoever it is that you choose to work with, there are several good firms in the business, but they really are critical being able to lean on one that you can trust and and will really go to the extra mile to really train you the way it is in the real world. You should be able to get classes from them at the usual processing, closing, HECM 101, those types of things. But what you see here, a successful originator will really approach this business not from a rate term perspective, but more of a overall fact finder. One of the favorite questions in some form that folks will use is, look, when we're all said and done, what goals do you want to accomplish? What do you want the reverse mortgage to do for you? And you would be amazed when you key off of those questions how the clients will go on for an hour. And what's also important is when to say no. We had a client initially that was torn between fixing their big old home, and they really couldn't take care of it anymore, or they weren't sure if they wanted to move, but they really wanted to get rid of their mortgage. Well, when we went through everything, it looked like they were going to have to bring $10,000, that little close to 11, to closing to retire their existing liens. So I said to them and to the realtor involved, I said, look, my true gut, if this are my parents, you have about $50,000 in equity, maybe $60,000 in the home. You say that you have the ability to take another $50,000 or $60,000 or $70,000 out of your retirement account or out of your savings to accomplish what you want to do. In my opinion, you're better off going from the old 4,000 or 3,000 square foot home that needs work, moving into something that's newer, smaller, fit to your needs. You don't have to cut the grass. And by the way, you can have no mortgage payment with a reverse for purchase. Now, we've put off what would have been an easy sale. And we may get it in a year, we may not. But the reality is that was the right thing to do by the client because it was clear that the client could no longer take care of the home. And when we're all done with the process, I said, thank you so much. We really appreciate you telling us, giving us an honest opinion. Okay, thanks. HECM has an origination fee prescribed by regulation. And this is one of the areas where we see counselors ask clients, or they tell clients, hey, you should go back and ask your lender to cut a fee. And there are two ways you can cut fees in the HECM world. The first is the hard dollar and the soft dollar. The hard dollar in our world is really needed. So when you see a $4,000 origination fee on a $200,000 home, people think, oh my gosh, look at those greedy lenders. They're taking all this money from the client. Well, what you don't realize is that in our world, we're prohibited from charging a processing fee to the client. We can't charge an underwriting fee to the client. We can't charge other junk fees to the client. Those are absolutely prohibited in HECM world. So that's an adjustment for a lot of forward firms that look at the space. So those hard dollars up front are very important. However, you have the margin that's available to you where if you can lower the margin as close as possible to the principal limit floor of 5.06%. And by the way, we can get into that in a different call because it really involves kind of some technical. But the closer you can get to the principal limit floor of 5.06% on a $200,000 home, you could be giving the client an extra $8,000 to $10,000 to $15,000. So what we'll tell clients is, would you rather have something discounted by $500 or $1,000, or would you rather pick up $10,000 to $12,000? And well, obviously we all know what that is. So that's the nice thing about HECM. There is flexibility in your pricing to make sure that you cover your internal operational expense and also the cost of, acquiring the lead, and then of course compensating your originators as well. Being the master of your own destiny. I am a control freak. Fortunately, my wife doesn't throw things at me, bless her heart. But to the extent that we can, we really try to control our operational destiny. I know many of the folks on the call aren't going to jump into underwriting their own loans tomorrow. However, at some point in time, if you have the capability, I'd certainly encourage you to explore it. And you certainly can do so via hybrid or the non-delegated route. And the investor you work with can certainly help you. For those that have the capability to issue Ginnies or are issuing Ginnies on the forward side, if you haven't already had that conversation with the folks at Ginnie Mae, it does require a separate approval. And the additional net worth beyond the forward approval is pretty significant. But in today's world, like with other MBS, if you have the capital to do it, it is rather lucrative and it's something you should look at. Leveraging your existing book of TPO business. The originators that survived the meltdown, again, you keep hearing me come back to the concept of referral-based, feet on the street. And I don't mean to overlook the mass media and those that have the capital to do it, on national TV and things like that, because that is an important driver of demand. And if you have expertise in that already on the forward side, you should be able to transfer that expertise to the reverse world. The TPO firms that are on the call that are, that really get the bulk of the business from realtors and the like, you're going to do well in this because you have the mindset. You're used to working sometimes with some difficult referral partners, and again, you're going to see that translate well into the HECM business. And with Wells, Met, B of A, and other large banks that are gone, there's a huge void to be filled in our world. In fact, one large bank here locally, they just tell clients, hey, we don't, we used to do this, we don't do it anymore, get on the internet. We don't know who to call. So we've started getting referrals from some of those large banks as well. So again, small, mid-sized lenders that are non-delegated. So if you're non-delegated, or you might be a small closed loan seller in the forward world, definitely consider at least sending out loans as a hybrid once you get used to the space. Because as we all know, there are certain advantages to acting as a lender if you're able to. Yeah, the traditional brokers under great pressure, but on the same hand, brokers were supposed to have been dead three or four times over. And I do think that once we finally transition to the new world, that there is a need for a vibrant local broker channel, because there always will be. So if you do have an existing book of TPO business on the forward side, you have a quicker in to the reverse world with the right staff and the right people, and most importantly, the right culture. So this is the emphasis that we're trying to put on growing the pie, if you will, the overall pie of the entire industry that was working very well back in 05, 06. Welcome to New Hampshire, Mr. White. Well, what we are seeing is that the reverse for purchase is really the hottest product in 55 and up communities. And for those of you that do a lot of business in the 55 and up world, you may have already seen that the new QM guidelines are starting to negatively impact those clients that would use asset depletion to qualify for a forward loan. So you have somebody coming in with maybe $1,800 a month in Social Security income, but they may have $200,000 in their retirement account, $200,000 in equity from the sale of their home up north. Well, they're going to take $100 of that, put it down. They want to qualify for a 50% down loan, which, by the way, the client happens to have a close to 800 credit score. So that would seem to be a no-brainer of a loan to make, right? Not so fast. If you really talk to anybody that's active in the 55 and up world, and I'm not being critical of the agencies, that's not my point here, but what we see is that the agencies are unofficially tightening guidelines for forward borrowers using assets to qualify, which is becoming a major issue, and it's becoming a nice pull of demand into the reverse for purchase. Because roughly speaking, at 50% down, you can put a client into a home and they have no more monthly mortgage payment. Now, of course, they have to pay taxes and insurance, and that goes without saying. But that is the beginning of a trend that's going to play very, very well in the reverse world. And obviously, financial advisors are starting to look at that as well. This is, in some areas, going to be a major emphasis going forward. In some local markets, it will be 50% of business or tracking towards it by the end of the year. Obviously, builders should be looking at it. Believe it or not, you can do reverse for purchase on manufactured properties. And manufactured obviously is a niche. And it's a niche that, in my opinion, I think you need to know well. But in the right parts of the country, where the models are newer, where they fit the newer guidelines, and they turn over, there's a fair amount of turnover, so you have no issues with comps, that is a good market to be in. And there's a lot of lenders that don't really realize the full opportunities here. We just mentioned about this client that comes in with a 750 plus FICO, lots of assets, low income. This is going to get worse before it gets better, but it's creating demand for reverse for purchase, which is a good thing. And again, you'll see some examples of how one would work, but basically for a $200,000 home for this particular client, they can get into a $200,000 home for right at $100,000 down. So this is a powerful product for this client not to make another monthly mortgage payment for the rest of their lives. Again, they do need to pay the taxes and insurance and HOA dues, but this is a powerful, powerful product. So additional opportunities from the servicing portfolio. We're going to turn this over to Brian Coester here in a minute, and then kind of wrap up for any questions. So if there's anything you'd like me to answer on the call, please feel free. We're going to run a couple minutes over, but not many. If you have a servicing portfolio, I would just kind of encourage you to take a look and say what percentage you have that's age 62 or over and has at least 50 to 55% equity in the home, or at least 50 or 55% LTV currently. The HECMs have been used over the last few years by some proactive folks that help keep clients